Okay, welcome everyone to our first panel on climate transition risks in consumer financial markets. I'm Chris Foote from the Boston Fed. I will be moderating. This panel will primarily focus on how climate risks are affecting systems of housing finance around the world. In the United States, we've all heard that the warming climate has raised the risks of wildfires in the West and hurricanes in the South and the East. The climate is affecting housing stocks in other countries as well. In Europe, for example, floods may become more common as climate risks increase. And we're going to learn about several ways in which climate risk can affect housing finance, including how climate risk affects the pricing and allocation of mortgage-related risks, how housing improvements, renovations necessitated by climate risk should be financed, and how national and international regulatory agencies should address climate risk. We'll hear today from Nancy Wallace from the Haas School of Business at the University of California, Berkeley, Ishita Sen from the Harvard Business School, and Bart Catry from the KBC Group, which is a large integrated bank insurance company headquartered in Belgium. Each panelist is going to give some introductory remarks, and then we'll open the floor for general discussion. So, Nancy, the floor is yours.
Oh, I can show it.
You can, yes, absolutely.
Thank you very much. Thank you very much. It's a pleasure to be here at a competing lab. I have to be at my lab at 7 o'clock tomorrow morning for a very similar group. But I wanted to talk to you briefly about what's going on in California with the insurance problems in the housing market, and actually it ultimately will affect the mortgage markets, although we haven't seen that problem yet. So I'm going to try to do this briefly with a few slides of pictures to try to explain what the dilemma in California is. So this is joint work with colleagues at Cal. So these two graphs are a picture of the, as you can see, the annual area burned in millions of acres in California and the annual wildfire counts. And as you can see, 2017, 2018, and then 2021, 22 were very significant wildfire burns. So in 2020, over 4.5 million acres burned in California. And the prior years, which are 2017, 18, it was more than 1.2, 1.5 million acres. And here, as you can see the counts, 2018 was a very big fire year with about 9,000 fires. And then 2021, 22, which were the most acreage, were also very high fire count years. And what this masks is the cost of these fires. So in the 2017 year, that was an $18 billion insured loss year in California. And I'm talking about structure loss. Not what it costs to fight the fire, then we're in the hundreds of billions of dollars. And then 2018 was another very spectacular set of fires. One of them burned an entire town, which was 18,000 structures, and it cost $20 billion. So what does this mean in terms of what these distributions look like? And this is part of the problem. In part, this is a modeling problem. Very similar to the problems prior to the mortgage crisis, which those of you that know me is what we work on at Cal. So as you can see, this is a very skewed distribution. So this is a graph of the logarithm of these annual burn areas, and you can see it's very right skewed. And so why is this something we should be keeping in mind? Well, it means the statistical forecasting of wildfire is going to be a difficult problem. It means methods to diversify and securitize wildfire risk. Think about the mistakes we made with securitization with mortgages. Is going to be a significant, serious, and difficult problem. The reserve strategies under value at risk is going to be a significant, perhaps, tool we'd like to avoid with these types of risks. And then thirdly, the design of risk management strategies that are used due to these spatial dependencies that affect many people, many properties, and many insurance lines simultaneously. Again, very similar to what we face with the mortgage market. And part of the problem is anthropogenic increases in temperature, climate-related, very large increases. This is a very steep curve. This is max temperature. And max temperature is very highly correlated with nearly all the other climate features that are used in the various models that we use to predict wildfire occurrence. And so, as you can see, fires are very sensitive to max temperature. Max temperature is highly correlated with these other meteorological features, and therefore it's obviously going to be a big part of our models and another challenge in terms of a latent variable that's affecting much of the feature space that we use in modeling these phenomena. And then this is the problem for the insurance industry. So this is a graph of the realized loss rates of California insurers. And as you can see, starting in 1617, we're talking about loss rates that exceed 100%. So over 2012 to 2021, the direct incurred loss ratio was about 59% in the US, and it's about 73.9% in California. In terms of the direct underwriting profit, it's about 3.6% in the US, and it's negative 13.1% in California. So this annual pattern of losses and their magnitude have led to a really serious intertemporal smoothing problem for California insurers. So thinking about what we're going to do about this, we need to think about a much more sophisticated class of model. We have amazing tools now that are coming from this institution, my institution, many other institutions that all of us are part of. But we have to start amping up our technology. We need to start thinking about tools that are suitable for these spatial and temporal, highly correlated phenomena with all the features that I showed you on the prior two slides. Oops, that's it. Oh, I'm missing a slide. Oh, well, it doesn't matter. What we find is that these new tools predict really well, but we don't have a lot of out-of-sample forecasting power yet. So these are big problems. I'm here to in part tell you that these problems need a lot of horsepower, and it basically should be all hands on deck to figure out how to address them. So what I haven't talked about are the policy responses to this. So in California, up until October of last year, it was not allowed to set your rates based on actuarial models. That means that probabilistic models were not used to price insurance in California to justify the rate structure. That's a pretty remarkable statement for a fundamentally probabilistic object, the probability of wildfire occurrence. Secondly, another important problem in California is that we have a dual insurance system whereby the normal market that all of us deal with is regulated on the basis of price but not quantity, and they can cancel policies at will. And we have a secondary market, a residual market, which Ishita is going to speak at least some, because many states have these, that is the recipient of all this non-renewal of insurance policies. And it's undercapitalized. And of course, when it fails, which is very close to being done since it's adding 100,000 new policies every year, the rate structure of the current insurance companies will and the people that are paying those premium will have to bail out the residual market. And then lastly, one of the great hopes, instead of more insurance, is mitigation. And mitigation is not cheap. What it means, the average age of a house in California is 48 years old. Most of these houses do not have fireproof roofs, and most of them do not have double pane glass. So I don't know if any of you have recently remodeled your home, but the cost of roofs and the cost of double pane glass is very high. And so this is a capital market problem. We need second liens that can help people finance this cost, because the problem is not going to be just solved with all the moral hazard problems that are associated with homeowners insurance. So we have a really interesting new problem in terms of building a new capital market. and then I'm going to cede it to my colleagues here on my panel of how our state and other states are going to have to think about solving this part of the problem. Thank you.
Ishita?
Great. Could I get my slides up, please? Awesome. Okay. Thank you so much. Thank you, Nancy, for setting up the issue so well. So what I'm going to do is I'm going to start off talking about how property insurance markets are responding to growing climate-related losses. And I'm going to first sort of tell you what the key issues that I think is sort of keenly on everyone's mind. And I'm going to tell you why that is just half the story, and we go from there. So the two key issues that I think are sort of forefront in people's minds these days seem to be, number one, that insurance premiums, that there is sort of growing risk of insurance premiums sort of skyrocketing in many parts of the U.S. So that's one. And second, that it seems that insurance companies are responding by exiting many markets in really large numbers. And so why not that's so absolutely true? There is a second part to the story, which is that while it is true that, growing risk of disasters are causing insurance premiums to increase in a big way, insurance premiums are not growing in areas that are most risky to insure, the area that are most facing most risks. And there is this growing disconnect between insurance premiums and risks in the U.S., and that's partly to do with regulation of insurance premiums, as Nancy alluded to, and so I'm going to speak about that. The second issue is that while it is absolutely true that insurance companies are... this better?
Okay, you're right.
Okay. So I'm having a bit of difficulty seeing my slides. If it's okay, I'm going to try to be as loud as I can be, if that's okay. Okay, I guess I'm going to go on and speak as loudly as I can. Can you guys hear me at the back? Okay, awesome.
Slowly point to where?
Okay. I do have yes. Okay, I'm gonna try to be as loud as possible. Okay, so while it is true that good insurance companies have been exiting in large numbers, it is also true that insurers that are new, that are of low quality, that are at extremely high risk of becoming insolvent, are entering the market in a large way and filling this gap, along with state-run insurers of last resort, as Nancy alluded to. And that these risks of very risky insurance companies backing mortgages are not priced in mortgage markets fully as of now. So I'm going to talk about, try to unpack these two trends in the time that I have, and then I'm going to sort of talk about the implications for mortgage markets in the end. So I sort of started off saying that there is this growing disconnect between insurance premiums and risks. So here are two charts that is trying to motivate that. So what you have in these two charts on the x-axis are expected losses per housing unit across different zip codes in the US, okay? And on the y-axis, what I'm showing you are insurance premiums. Now, there are two graphs. The graph on the left shows you states that have less price regulation or less rate regulation in the US, and the right states that are highly regulated. So in the US, insurance premiums get regulated state by state. California is one example of where it's really hard to sort of update prices. Virginia and Massachusetts, it's relatively easier to increase prices. So what you see is this sort of disconnects. On the left, you see the strong positive relationship between insurance premiums and risks, which is exactly what you should expect. Insurance companies should want to charge higher premiums in areas that are more costly to insure. Okay? Now, while that is true, in states that are less regulated, that relationship seems to sort of not hold to the same degree in states that are highly regulated. So states like California and states like North Carolina and Texas and so on. Now, there are two reasons why there is this growing disconnect between insurance premiums and risks. So on one hand, you've got this situation where there are a subset of states where regulation is really binding.
And it's extremely hard to change prices in these states. So states like California, okay? And so over time, what has happened is that rates have sort of not adjusted in response to growing losses in these states. Now, on top of that, what you also have is this is sort of an industry where insurance companies are typically national operators. There's returns from diversification. You want to be selling insurance in across the US. And so these national operators, what they end up doing is that they end up cross-subsidizing their business in highly regulated states by raising rates in less regulated states. So what you see in the data are that when there are losses in California, which is highly regulated, insurance premiums do not rise in California or in other states that are wildfire prone, but instead end up rising in states like Virginia, which are less regulated and not necessarily exposed to wildfire risk. Okay, and as a result, what has happened over time is that rates have outpaced the growth in losses in these states, because rates not only increase because of losses in Virginia, but also because of losses in all the other states that are highly regulated in the US. Interestingly, the New York Times actually recently did an article on this, and we essentially ended up replicating our findings. So this is a graph that they put up. So those are less regulated states, and these are the exact definitions we're sort of both looking at. And essentially, they end up finding the same thing with 2023 data, that rates in highly regulated states do not reflect risks in the same way, and that insurance premiums end up increasing in less regulated states. So with that, let me sort of switch to the second fact that I alluded to, which is that good insurers are exiting, but really low quality insurance companies are entering the market. Now, that's not what we expect. We don't expect that because insurance companies are extensively regulated. Their solvency is extensively regulated across the US. And also because the GSEs, Fannie Mae and Freddie Mac, they require that the insurer backing a mortgage is of a good quality, okay? And essentially what the GSEs are doing is sort of setting a floor on who can operate in this market, okay? And effectively acting as like a de facto regulator of this market. Now, despite all of that, what we see is that there is this dramatic growth of really low quality insurance companies. Now, I'm going to show you data from Florida, but these trends increasingly hold in other coastal high-risk states like North and South Carolina, Louisiana, and Texas, and so on. So what I want you to take away from the graph that's on the left are two things. So one, the line in the middle, those are traditional insurers, so all states and state farms of the world. You see that they're steadily exiting Florida and have been sort of, for a very long time, exiting the market, and so their market share has been declining. At the same time, you see this massive increase that the red line is sort of almost off the charts. You see that they are the insurers that are part of that red line have been sort of growing in a big way. So who are these insurers? These insurers are all rated by this new rating agency called Demotech, and so that's why we call it Demotech insurers. So these are insurers rated by a rating agency called Demotech. So they have been sort of growing in a big way, holding about 60% of the market share right now. So what do they look like? So these are insurers that are underwriting in the riskiest part of the state. They're often single state, less diversified insurers. So they would sell insurance only in Florida or Louisiana, or only sell homeowners insurance and nothing else. So they tend to be less diversified. They also tend to hold less capital relative to the risks that they hold. And looking beyond the operational and financial metrics, if you just looked at how many of them have sort of gone under during the time of our paper, which is the period between 2009 and 2022, that's the sample that we're looking at. So about 20% of the insurance companies that were there in 2009 went insolvent during this period, okay? Relative to about negligible insolvencies in the traditional sector. Now, having a bad insurance company back your mortgage is bad, because what happens in the aftermath of a hurricane is that these insurance companies are not going to pay claims or not going to pay in a timely fashion. And so that means that you might actually end up seeing a lot of mortgage defaults. And that's exactly what we see. So we see that in households sort of having a bad insurance company end up experiencing large mortgage defaults. So I want to just talk about couple of other things before I stop, which is why do we see such a big growth in these Demotech rated insurers, okay? As I sort of said before, GSEs are setting a floor, and sort of they decide who are the insurers that are going to be operating in this market in some sense. And that floor doesn't seem to be calibrated to risks in a proper way. So by that, what I mean is that the table on the leftmost corner there is showing you the eligibility thresholds that the GSEs require for a mortgage, for an insurance company to back a mortgage before they would be willing to take that mortgage on. Okay, so they accept ratings of AM Best, which has been around for a very long time, as well as this new rating agency called Demotech. And those are the rating thresholds. So this is saying as long as an insurance company has a Demotech rating of an A, the GSEs are willing to purchase that mortgage from lenders. Okay. What does Demotech do? Demotech rates them all an A, as you can see from the histogram there. So there's a massive amount of bunching at the A rating at the GSE eligibility threshold. But our analysis show that actually many of them would not be eligible if had at an AM Best rated these insurance companies. And so about 70% of them would not meet Freddie Mac's threshold, and about 30% of them would not meet Fannie Mae's threshold, meaning that the GSE's rating thresholds across rating agencies are not calibrated to risks in the same way. Okay, so I just want to quickly end with sort of talking a little bit about the effects on mortgage markets. So key question, of course, is how lenders are responding to all of this, and to what extent are these risks priced in mortgage markets. And so what you see lenders do is that lenders are actually keenly aware of the risks insurance companies are posing. And so they behave very differently in two different segments of the market. So for loans that they end up retaining on balance sheet, or so-called jumbo loans that they cannot offload to the GSEs, they seem to be pricing the risks of insurance companies failing in this segment of the market by denying mortgages and by charging higher mortgage rates. They continue sort of originating mortgages in the same way in the conforming segment and end up offloading these mortgages to the GSEs. Okay, and so that means two things. So one, who is left holding the bag? It is the GSEs and therefore the taxpayers that are ultimately holding the risk of these insurance companies failing. And so they are the ones exposed to climate risk because of the failures of insurance company. And second, that there seems to be too much credit being originated in the conforming segment, where lenders are just simply originating and sort of offloading to the GSEs. Okay, and why this is bad is because our financial markets, which are supposed to provide the right signals of risk, so these big financial markets, insurance markets and mortgage markets, are not providing the right signals of risk to households, and as a result of which you see too many mortgages and potentially too much development happening in the riskiest parts of the country. And that in itself can sort of create more risks for people, for financial markets, even in the absence of anything sort of changing in the underlying distribution of climate systems. Okay, so I'm going to stop there, and happy to discuss this more during the Q&A.
Can I have also in those slides? Okay. Okay. I will take this from probably various different perspectives now. So first of all, we will cross the ocean. We will go to Europe. It will not be about fire, but it will be about floods. And it will not be, let's say, from a pure policy perspective, but rather from, let's say, the financial institution itself. So I hope that may be interesting to you. Let's start with the policymaker in Europe. Or at least the supervisor of the financial industry, so the ECB. They already outlined in 2020 with the guide on environmental risks, how financial industry should deal with these environmental risks. I took two extracts from that guide, which can be relevant here in this discussion. So the first one is about the pricing framework that you set up for your different products. If you change your let's say business strategy to meet certain sustainability goals, then the expectation of the ECB is that you also adjust your pricing accordingly. So actually, as an example, if you no longer want to finance very high energy inefficient housing, then you have to start differentiating the price for a mortgage based on the energy efficiency of the house. So that makes sense. The second is that as part of the price, you also have to include all the risks, so credit risk, but also the actual new credit risks, so coming with environmental risks. So basically, if you are located directly in a flood zone, then you somehow have to take this into account in the price of the mortgage. This guide is really a guide, so there are a number of expectations, but let's say ECB is quite, let's say, strict or actually enforcing this. So it was actually put here a quote of a speech of the beginning of this month by Frank Elderson, who basically says, if banks do not follow the guide, and we will follow it up during the supervisory dialogues, if they do not progress sufficiently, then actually it can be, the financial institution can be penalized. So just to put more pressure on financial industry to follow the guide. Now, as I mentioned, we will look into water, so flood risk in particular. And the large map on the bottom is basically the region where I'm living. So it's somewhere between Germany, France, UK, and the Netherlands. And you can also see all the shades of blue in that map. They reflect areas which are prone to flooding. And there are several, let's say, degrees there of severity. But from the picture itself, it indicates that this is quite widespread. If you focus a bit more on those where it actually really matters, so where the flood depth can be relatively high, when it can actually occur quite frequently, then let's call it the high risk areas, then this story becomes a bit more nuanced. And that I try to show in a table. I did it not only for my region, but also for the 5 home countries in which KBC is active. You can see it, and there are different types of flood. You have the sea level type of flood risk. You have rivers that go over their banks, but you also have very heavy thunderstorms, which make that the water doesn't go anywhere. So you can differentiate across these types, but even then, on average, let's say it's somewhere between 1% and 2% of let's say exposure or assets in our portfolio that are at high risk. So they are located in one of these areas. This is a bit more nuanced than the map itself, but still it's not negligible. If you zoom deeper into the map, so the picture that you see here now, you can recognize houses, streets, and some different shades of blue. And the darker it gets, the more severe the risk is, the lighter, the less severe. And the light blue actually is also including an adverse climate scenario. So the other shades of blue, they are accounting for the current climate. The light blue is also accounting for some adverse climate scenario. What can you then do with such a map as a financial institution? These maps, they are already there for decades, and typically insurance companies have been using these to basically build their actuarial models. Reinsurers, they build these maps themselves. But as a bank, it's relatively new to also start to work with these type of maps. So what can you do? You can look at, okay, the high-risk areas. That's probably the areas where you start to wonder, should we still finance mortgages for properties located in those high-risk areas? So that's let's say a business question, do it, yes or no. And probably you will also adjust the collateral value. So the price of the property, or the collateral value will be impacted whether you're located in one of these regions or not. That's relatively easy. Right? So you know the location, you put it on the map, and you can identify what is the risk. The difficulty becomes, or the challenges are actually that, especially in Europe, when we grant a mortgage, we actually hold it on. In many cases, we hold it on the book. So which also means that if you grant a loan, that you lock in the potential risk, and the risk today may not be the same as the risk in a few years' time. So that's a bit a challenge. So you can start looking, and that's what the red circles on this map. So probably in that lower circle, there are a few properties which are already today at very high risk. So there may be some doubt that you still want to provide a mortgage. The one on the top there, you see it's already in the adverse climate scenario that these can become prone to flood risk. So you have to decide, okay, what do I do? Do I already take a forward-looking scenario into account, or do I not do this? So that's the first challenge. These forward-looking climate scenarios, they are also, especially when to translate it into flood risk, this is relatively new. And I've been talking in the past weeks or months with various providers of such maps, and they all have their different approach. They all have a different model, a different climate model that they are using, which also means that if, let's say, KBC starts using one of these models and our competitor uses another model, you actually can have a situation where we may be losing opportunities, or they may be also losing opportunities. So that's, let's say, also a risk. And then the last one that I put here, it's also mentioned already before, how to translate it then into the actual risk and premium. And in this case also, the credit risk. In the end, it's a secondary effect. So the mortgage or the property can be flooded, but it's only in the case that it's flooded and there is damage to the property, and the client at that moment defaults, that the bank actually has the risk. So that's let's say a mixture of dependencies, over-insurance, under-insurance of the property as well, and that actually makes it very hard to calculate the exact credit risk of this property. The last slide that I had here is something completely different. I don't know whether I still have a few more minutes. Okay, and it actually refers to the first expectation of the ECB that I pointed to in the beginning. So fire and water, they are very tangible when it comes to climate. But Nancy also mentioned retrofitting of houses. This is important. And as a financial industry, we are also expected to support this type of retrofitting. And here the story is more about the energy efficiency of houses. So EU has set certain targets. So by 2050, the building stock in the EU has to reach a certain level of energy efficiency. And they are looking into financial industry to support this, ambition, and to also support retrofitting programs in the different nations. So we have a very, let's say, ambitious target. As a financial institution, you also set your own targets to let's say, be in sync with that target. And what I show here in the graph is actually a kind of monitoring that we already have to do now to see whether we will actually meet the target in 2050. Is the, let's say, energy efficiency distribution in our own mortgage book, is that evolving in the right direction? And can we already try to project whether it's evolving in the right direction? so that if needed, we can already start, again, adjusting our pricing framework so that we can steer this evolution into the targets that we have committed to, and not only EU, but also as a financial institution, we have committed to. So this is a means to actually differentiate further the mortgage lending and basically steer inflow of better performing houses versus worse energy efficient houses. But that's more or less what I wanted to say.
Okay. Thanks very much. Let's open up the general discussion. There will be a microphone coming around for people to ask questions. I would ask that you wait for the microphone and I'll call on you. Please say your name and your affiliation before you begin your question. I want to take the moderator's prerogative, though, and ask a question, sort of a general big picture question here, which is that as climate risks become more salient, you would expect that to, you would hope that that would ultimately be reflected in where people are choosing to live and whether or not we see high risk areas have lower population or lower housing prices. You would think if the price system is working in the right way, that would happen. But on the other hand, there are all of the distortions that you've talked about that prevent those price signals from occurring. Could you say a little bit about whether or not you think we're actually seeing these price signals? Are the distortions so bad that the signal's not getting to people? It is not really affecting the desired locations of where people want to live? Nancy, I saw you shaking your head, so.
Yes. Can you hear me with this? In California, this is a serious problem because we haven't been in pricing insurance since the beginning of time. We have a big spatial allocation mismatch of where houses, where infrastructure, where real estate is placed. And also the peripheral areas are very much at risk in the urban areas because they're poorer populations. We also have a lot of manufactured houses, well, made out of plastic primarily, and they have a huge risk. What I didn't show you is we've also been working on the losses given wildfire, just like we would do in the mortgage market. What are the losses given default? And there are certain classes of housing, often at the peripheral areas, that are extremely at risk. So if there is a fire, they will burn to the ground. The other big problem was up until 4 years ago, 2019, as you know, we govern ourselves in California with propositions. The insurance companies strongly forced people, I think is the right word, to rebuild on the prior lot. So you would not get the proper payout on your mortgage insurance, renegotiation on a burned home. And when these fires occur, and I say 18,000 houses or 9,000, these houses burn at like 2,000 degrees. The rebar on the housing melts. The rebar goes down 30 feet to the rock. It is destroyed. So these houses are burned to the ground. And the goal of, you would think, once fire areas have been identified, we've seen the maps. Most of the maps are wrong, by the way. And then making it really the only solution to resolve a loss is to rebuild in exactly the place you were. And that's what the state law basically reinforced in the state. So up until 2019, most of the houses were rebuilt exactly where the homes burned, including in Paradise, California, which is post this change in the law. Paradise is being rebuilt in exactly the place it was before, including its downtown, which was funded with a municipal bond, which is the first municipal bond failure in the United States. It is being rebuilt in exactly where it was before. So in answer to your question, I think just the reality of the amount of buildable space in California, the fact that a lot of the desirable lots, especially vis-a-vis views, proximity to where industry is and where most of our economy is, are not in ideal locations. And it's going to be very difficult to move them away to safer places. which is why I lean on the mitigation side of things. At least it's in line in incentives with banks, with insurance companies, because it should reduce the risk. So if we build better, it should be less likely the homes burn to the ground. And that's what our models show.
Interesting. Anything else to add here? Or?
Yeah, I just wanted to say that this is not just a California problem. It is a US-wide problem. There are many states like California that have extremely high amounts of regulation, North Carolina being one example. And so these distortions are widespread. And so there's distortion from rate regulation. And the other side is also important thing about states that are less regulated, where the prices are too high relative to risk. So what's that doing? Is that sort of leading people to buy less insurance than they otherwise would? So are they underinsured? And then what happens to them if there's a climate shock? And then there is distortions coming from the GSE side. That's another things that I was alluding to. It seems to be the case that jumbos are pricing some of these risks, but a vast majority of mortgages are conforming mortgages, and they seem to sort of not price these risks.
Well, I cannot speak that much for fire, because as you may have seen on the table, we were not that exposed to fires.
You're lucky.
But when it comes to flood, actually it's a bit the same. So we have a legacy building stock, and okay, today you will not build anymore in a flood-prone area, but the stock is there. So yeah, the risk remains.
Interesting. Okay, I saw John Campbell had a question.
I was looking at the microphone for John, so if you speak up and then make a repeat, you can summarize the question when you answer it.
Okay.
Work on that strategy for a moment. We get some
I'll take notes, John.
Okay. I just wanted to follow up on Ishita's very interesting point about how subsidy regulation from the best regulated state. Right. So my question is, why did the insurers got to get? Why does that public? Why didn't they just draw out of California and make money in region? There must be some other element in the story. Actually, the public exploited the stops the environments.
Okay, so if I could get the question correctly, you brought evidence of cross-subsidization. You can't raise premiums in California, so you raise them in Virginia. How is that a profit maximizing strategy? Why don't you just drop out of California?
Yeah, so absolutely. And you see exits have made as well. But exits seem to be a more of a long rather medium-run response. There are barriers to exit states because so insurance companies often bundle products together. So if they are in California, if they don't sell homeowners, their auto insurance business, which otherwise might be profitable, will not sort of work out for them as well. So that's one reason, bundling. Second is there are actually explicit regulatory pressures to not exit. In many situations. So there's that. Then there is it's really costly to sort of enter an exit stage as well. So all of that means is that, of course, I mean, there would be a point where it would be untenable to operate in some of these states, and you therefore see exits happening, but it's just much more slow moving. But in the meanwhile, you're doing all of this crazy distortionary price raising on the less regulated states, and that sort of breaks down the risk signals that you get from pay.
Great. We have a question here.
Here to school that it's again so they are very interesting but anxious. You emphasize somehow even these the regulations, you emphasize the problems to the rights and the markets and how they pay. But so it sounds like you're alluding to a solution being just and deregulate and let competition do the job. Let's ensure by if Senate set the prices they want. What you didn't say that. Are you thinking that would be the solution to problems, or is they think about we not damage runs?
Okay, sort of to rephrase that, Ishita's presentation discussed a lot of the problems that come because of the specific type of regulation that matters for the Florida housing market, Florida insurance market, and in California as well. is the solution to step back from regulation and have less regulation in general? Would that solve a lot of these problems?
Right. So you're absolutely right. Regulation exists to solve a certain problem. In this case, it is potentially that insurers have too much market share, and they probably might actually set prices that might be too high. And that probably is one national regulation. I think what I was alluding to is not that you should not have regulation, but the fact that you have this heterogeneous regulation across the U.S. where there are different rules in different states, or give insurance companies the room to charge prices in a way that are not necessarily do not make sense with the actually that.
In California, the situation is a little bit different because, again, of these propositions where we sort of self-rule through voting. These are voted by the population. So the rule that she's alluding to in California is another proposition that was passed in 1989, and it explicitly says that statistics can be used to deceive people. It was designed by Ralph Nader, who was a consumer advocate, ran for president. And there is this view that these are complicated products. We know that people don't read their policies. They're very difficult to read. And so there is kind of a gap between what's being sold and what people think they're buying. Now, this is also true in the mortgage market, but of course we regulate the mortgage market as well. So I do think there's a gap, and just unfettered competition may be a problem because these are complicated problems. But I think Ishita's right. We need some kind of a homogenization of the type of regulatory practices across the country. And that's going to be difficult because this is a state-regulated market right now.
Actually, I want to follow up on that very quickly and bring Europe into this, because banks in Europe, particularly large banks, can face a number of regulatory layers, including the ECB. We saw a slide there, the national and local governments. Given that these climate risks are relatively new, is there a danger that the different regulatory agencies and layers will provide banks in Europe with sort of conflicting instructions on how to deal with these issues?
Well, actually, our supervisor at ECB is, as I mentioned in the beginning, is quite, let's say, sticking to the plan. So they set out the guide, and then they, many years later, are following up on the progress of the different banks. So let's stick to the plan. While the national governments of EU each have their, let's say, their own, let's say, there were quite a lot of elections in the past year, where actually the transition and taking climate risk into account, the voice of the people who are, let's say, facing difficulties with that is getting hard, it is getting louder, and politicians are then also picking up that signal. So they are, let's say, policies that were in place are being reconsidered, policies that were planned are putting on hold. I can give an example. It's not so much pure on the flood, but rather on the last slide that I showed. In the region where I lived, when I would buy a house and the energy efficiency level is actually very poor, then I'm obliged to renovate or retrofit that house within 5 years, up to a certain level. And then this rule was actually meant that in 5 years' time it would then become even more strict. The elections this year are passed, a new government in place. They abandoned the strengthening of this rule, which means that if you now buy a house, the price of your house can be impacted by this changing regulation. So the moment that you buy or sell your house, it can be dependent on the potential regulation that either will be still in place or that it will start to be softened. So our supervisor is, in that sense, again, very, let's say, stick to the plan, while national governments tend to use more volatile and can have impacts on, say, prices of that parts. As a bank, we should manage that, but as a say the clients, our clients are actually impacted both by this.
Okay, we had a question here.
Working with Northbelt, Catry. Actually, what is actually why the insurance not me to that seems it could be that in these either in the US but even across Europe. Europe has had a very large insurance. These insurers are in Europe. So, why is this not an answer to some, my secondary question was about premium. If I were an SEC that was looking at this new rating agency and they was all either rated that they're paying, I would be on this. That's the ones their ratings not manufactured, but they are rated on the low quality insurance and they rated. And we went through they re-rated what they would see back in 2008. What's going wrong here? Why is this in our
Okay, so two questions. One is, what's the role for reinsurance in the United States? Why isn't that being used more? Actually, why don't we start with that and then we'll go to the second question. So, Nancy?
So the reinsurance market is also prohibited in California. So up until October of last year, it was not allowed to use the reinsurance rates, which unbundled fire insurance in 2017 as part of the rate request proposals from insurance companies. So, and that unfortunately, even with this new change where we are going to allow probabilistic models as of November, has not been changed. So including the rate structure of reinsurance in the rate setting policies of California right now is not allowed. Parametric insurance and reinsurance is allowed for the earthquake insurance markets. And so we're heavily using those right now, but of course that market broke many years ago with the Northridge quake, so that's entirely public market, and very few Californians have earthquake insurance. At the time of the Paradise Fire, I worked with the commission on that, trying to get them to think about parametric solutions to some of this, especially in the national forests, and they would have none of it. So that's another problem because the reinsurance markets are heavily probabilistic models, and this has been the big sticking point of getting those accepted because it's a very political situation. And so right now I'm not optimistic. Ishita, you're not for the second wish.
I just also want to add on the reinsurance point. The reinsurance, I mean, you should think of reinsurance as not for capital. What happens after disaster is that reinsurance prices go up a lot.
Yeah.
And so insurance companies, they're not able to pass on the costs to consumers or the rate regulation or whatever, then it's not so easy to sort of just access those markets because that's going to sort of really lead to a lot of fluctuation in their earnings and so on. So you see about 20% utilization rate for reinsurance using what's an average. And on the rating agency question, they're absolutely right.
Actually, let me rephrase that question about rating agencies, because the second question was about why it is that this particular company in Florida that's rating these insurance companies very highly wasn't sort of called on the carpet by the Securities and Exchange Commission or some other regulator. How are they able to get by with that?
Sure. So we know that rating agencies have been regulated by the SEC since about 2007. So that's when most rating agencies, Demotech, before regulated, started getting regulated from 2022. So before that, the SEC was not looking at Demotech. It was not NRSRO certified, so to speak. And so before that, they did all of this. Interestingly, an anecdote is that when they got their NRSRO certification, they wanted to downgrade 18 Florida insurance companies. And then there was a massive pushback from politicians in Florida to do so. And they dialed that back. They did not downgrade the rating companies. I think I might be getting my numbers slightly up, but about 6 of them then ended up getting becoming insolvent just after Hurricane Ian. And so, yes, I mean, might now observe Demotech ratings might be more reflective of risks going forward, and now that NRSR and FSAs started looking at it, but historically they haven't.
Okay, great. Other questions? Here,
So I wanted to follow up a little bit more on Europe. So it's really interesting that you said that the to not write mortgages in areas that seemed quite dangerous. And I feel like in the U.S., that would be something that goes down lightly. I wonder if you could say a little bit more find out possibly when imagine in the U.S. it would be because of the GSEs and the fact you need insurance to get a mortgage. You say the equity where the calling project. In Europe, is there an institution that forces homeowners to try insurance, or do the properties then just get sold and funded without you're not putting insurance, but what happens to these properties if someone can't get a mortgage? Does the value go way down? What is exactly happening?
actually, to rephrase that, is the question, Debbie, is it about the bank not giving a mortgage or not being able to sell insurance and therefore?
I really meant about the bank not giving a mortgage. It's like in the U.S. would be a lot.
So is it possible, like in the United States, it would be very difficult for a bank or loan originator to say, we're not going to serve this area because it has a high risk of climate. Is that more possible in Europe? And if it is possible for companies or areas to be, in a sense, starved of mortgage credit, what happens to the housing stock?
To answer the first part, it is possible indeed. So it depends a bit on country by country, but in the country that I'm living, you're indeed obliged to have, when you buy a property, you also need insurance for that property. Otherwise, if you want to have a mortgage, the unit actually, you have the collateral, so you also need insurance for that collateral. So that's the link with the insurance market. So if you cannot get the insurance, it cannot be used as collateral, so you cannot provide the mortgage. So, and that's, let's say, perfect legal to do. I'm not saying that this is widespread. The story that I brought earlier is relatively new. We are, let's say, requested to look into these risks and take these into account in providing loans. And we indeed have to be aware of these new risks and we have to manage these. And it indeed, in some cases, but these are relatively rare, you can say, okay, this is too high risk, so we no longer provide funds.
Okay, great. Question here?
Or is there a question about mortgage? I'm saying, like, standing right next door, it doesn't matter. Who knows about a new one? There are thousands of cross subsidies in the mortgage market. New Jersey, about 50% higher loss given the problem in California due to the timeline. If you look at the GSE data, they almost never lost money on hurricanes, except for perhaps Puerto Rico. They have lost $100 million on earthquakes, and that's not price here. How big is this cross subsidy compared to all of the other cross subsidies that are the natural product, the natural mortgage market, the sort of a policy choice?
Okay, so to summarize, the mortgage market is full of cross subsidies across different borrowers, across different states. How large is this particular cross subsidy in relation to these other cross subsidies? And I guess the implication is should we expect something like this to happen in a system of national housing finance?
Right. No, that's a great question. And in fact, we are actually doing precisely the calculations that you have in mind. I don't have a number for you right now. I can follow up. But if you look at our default numbers from Hurricane Irma, so that's just one hurricane, of course, and sort of take that and try to figure out what proportion of GSE's expected losses in Florida are related to hurricane-related losses. So that's about 18%. That's a number we get. So that's just Florida. That's just one hurricane. But the kind of calculation that you have in mind, which is sort of peg that number against all of the other distortions that we know that the GSE's pricing rules bring about, we don't have that number exactly. But that's a great great question, and we want to do that.
So in California, the payouts on fire-related insurance have been high enough that there really is not a huge default risk associated with it right now. The bigger problem now is non-renewals, the breakdown of the industry completely. As I showed you, the loss ratios are not looking very good right now. And less insured people. In other words, that people will be insured enough to get a mortgage, but it will not cover the losses. But given that we historically had replacement, guaranteed replacement, all kinds of ambiguity on that word alone, and in California, any contract that has ambiguity on a word like that is always resolved in favor of the insured. So the payouts on these policies have been very high, and default rates are not high associated with fire yet.
I thought we have a question back here.
But I mean everything that are in. So, given the problems, what should policymakers' objectives even be within this market? Should they encourage lower premiums, more insurance competition, or just remove people from the high-risk climate area?
For a question. So what should policymakers be looking to do? Should they be looking to encourage people to move out of these high climate risk areas, or should they sort of try to keep policy low and go from there?
So moving out of the high-risk area would be abandoning Silicon Valley, and that's not going to happen. So it has to be something about pricing the risk accurately, and then something about mitigation such that when fires occur, they can be fought. So that's in the public sector. The other thing I haven't mentioned is the utilities and the grid. We have several rogue utilities that haven't maintained their lines. And a number of these fires, in fact, two that I mentioned, were directly attributable to the utility. So we have set up a large subsidy program for the utilities to try to incentivize them to start maintaining their grid so that they don't burn down houses. And I think it's more that of thinking about these peripheral areas, certain types of housing, kinds of mitigation that can be effective and that potentially could be subsidized, because insurance can only go so far. I mean, the first thing we teach with insurance is moral hazard. And it's very true. We can't just lean on insurance. But the insurance we do provide needs to be priced accurately.
Lori, can we?
And so, okay, so two questions, comments. There's sort of one is work in the insurance market, but that's, you just hit on one of which is the moral hazard.
Yeah.
You know, and something, you're looking at by, you work this at, you are getting, so, there's an incentive to, so your 19-year-old who was replaced by a root to one of reasons. So insurance rates are higher as they need to be there because it's a massive fraud. And, my car gets into an accident, the insurance company doesn't buy me a new car, they this market value that I want to use for most. Yeah. And then the second, and I don't know how to get around, so I don't know. But the second issue is, obviously, one risk is either having your demons on the habit, otherwise don't. Why not require everyone to have flood insurance in an area where one is minimally for anywhere within year zero?
So the question is moral hazard again, insurance. How do we think about that in this context? And, why not sort of force people to perhaps buy, for example, flood insurance, even if they're not in a flood zone, thinking that the policy would be priced accurately so there would not be a distortion? Is that a fair?
Yeah, for two separate.
But
they're not all the child with medicating your own work, you're on the flood side, many people don't have policy, and you're underinsured, and you're a way to correct those distortions. And on the flood side, one way to correct the 40 required road. I
can start, but I'm not sure I'll do a good job answering this one. So you do have in homeowners insurance, you're 100% required to have insurance. So that gets solve some of the adverse selection that you were alluding to.
you're overinsured, but the Wallace and Children.
Yeah, and so on the flood side, you don't have that. In fact, you are required to have that in flood zones, but even where there's non-compliance, even in within flood zones, and so there is a problem of enforcing that ex post, and mortgage services often sort of not do that as well.
So, Lori, pointing out something really important, what we also find after these fires, the houses are always larger. Their square footage is always larger. And part of the problem is that there are many parts of the payout on an insurance policy. And one of them is your personality, like what are your shoes worth? What are the dishes worth? And often it's calculated as a fraction of the overall payout. In other words, you don't have to buy a shoe to get a reimbursement. Whereas for the house, you have to build a house and then they pay you on installment. But there is an issue there. I think what you're likely to see is more underinsurance rather than overinsurance, because we are seeing this very persistent pattern of post these big fires. The stock is much larger. It's by dint of building requirements, it's much safer, but it's also just the square footage is larger, suggesting there's substantial moral hazard in the whole process.
Yeah, and data-wise, you're absolutely right. The average home in the U.S. has something like a 70% coverage relative to the full replacement cost. So it doesn't seem like people are overinsured, at least on average.
May I click into the second question that you had on the plot? So there, when looking at my own, let's say, country again, but I think in many European countries it's actually the same. The insurance market, I tend to learn now, acts a bit differently. So what you're describing, to actually have a much broader base of people who are having the insurance for flood risk, that's actually what we do. So we don't insure every physical risk independently. We have a broad package. So we are insured against flood, earthquake, fire, whatever, as a big package, as a homeowner. And every homeowner has you can go to the different insurance companies, but every homeowner has such a package. So we broaden the base, a lot, which is actually what you're, I think, looking for.
Yep.
One other point, Lori, what I do think is going to happen is the municipal bond market is going to require fire insurance. And that will be global in California because all our infrastructure is exposed, and that's how we fund it. So I do think there are markets that are probably more amenable to like a global you must have than fire insurance for homeowners.
So I have a question actually for you, Nancy. You mentioned the statistical modeling that has been developed as part of the addressing climate risks. Could you talk a little bit about sort of what those models do? What's on the left-hand side of those regressions, of how do they differ from what mortgage modeling has been traditionally?
So in California up till this October, what the insurance companies used was a backward-looking 20-year mean of their actual loss book of business. And given the graph that I showed you of max temperature, which is an exponential, obviously that's a rather short-sighted statistic to be using for pricing insurance. So for the smaller companies, that is all they have been using. The larger national companies that are in the state, like Allstate, any of the other big ones, Farmers, they use what are called CAT models. So these have a similarity to the mortgage market. They're usually something like logistic regression or some kind of a sigmoid, a hazard model of some sort. But nearly all of them are linear. Some of them have some nonlinear elements. They do not handle spatial correlation well. topography is a huge part of this modeling problem.
So let me clarify something quickly. When you talk about a logistic regression here,
Left-hand side, 0, 1.
right? But you're talking about, will this house burn down?
That's right. And then the next stage of that is, if it will burn down, how will the fire spread? So those are another class of model. And then there's another class of model, just like in banking. If there's an event, what are the losses given the event?
So when we're modeling individual mortgage default, if I default on my mortgage for whatever reason, my neighbor is not going to default.
Exactly.
But if my house burns down,
That's the problem. It's these interdependency, given the latency of some of these driving factors like max temperature, but also the fact that this is changing very rapidly. So we know these things they're huge dynamics. And so in the mortgage market, we might use all of the bank's book, all of Fannie and Freddie's book to build our models. But the problem now, when you're dealing with a latent variable that's just a recent phenomena, it may be that the more recent data are more informative to what tomorrow is going to be.
and it sounds a little bit like the difficulties of predicting aggregate risk of house price declines in securitization, right?
For sure, but it's about correlation. It's the securitization problem, just like it was for the mortgage market, is about correlation. And those are intertemporal, and then they're spatial. So it's both spatial, what's next to me is likely to share my risk, and also over time, what today's treatment, say for max temperature, means tomorrow's going to be hotter too. So we need to get those correlations properly set up. And even the firms that are using machine learning models, they're all using static machine learning models. So this is a flaw of some of the machine learning models. And so there's a lot of work going on right now and thinking about, there are now some physics-informed machine learning models that I've worked with colleagues. But I think for the banking sector, it's more the dynamics in time and space that need to be developed. And that's where machine learning models can be really helpful.
And it sounds like these types of models could deliver extremely large differences.
They can.
I mean, because it's almost like a multiple equilibrium.
Absolutely. And little things like California has 2 mountain ranges. So literally going up a street, you get differences in what's called aspect, how much you're facing the setting sun, which heats the earth the most, or even Northern California and Southern California. So we're seeing a lot more fires in Northern California just because of the topography. So we're using hourly data in our models, and so are the people that are trying to tune up these models, because you need measurements of interdependence in space, and that can only be measured by hours. So these models can be built, and I think just like we did with Dodd-Frank, which is inside the Fed, we built models, we vetted the models that the firms were using. We all need all hands on deck. John, this is for you. We need all hands on deck to figure out these models, and then we need to think about how they can be dispersed.
But it seems like there would be a tension between, if you develop these models that could deliver very large differences.
Yes, absolutely.
When you take that to the state regulators,
Absolutely.
my static machine learning model says this house needs 5,000 more than this house. Getting the regulation to understand that might be a challenge.
Yeah, and I think Bart alluded to this. The maps we're all using are 100% wrong. And so we need to get people more sensitive to the fact that these are sensitive changes. And I really do think we need to do some work with consumers, understanding their understanding of risk so that we can start educating people about what this stuff is all about. And we haven't done either of those things.
Great. Well, I actually have another question as well. I want to talk about mitigation because when I see pictures of the Paradise Fire, I saw pictures of the Paradise Fire, it doesn't seem like there's very much I could do to a house to prevent that house from burning down. Is this mitigation primarily designed to prevent fires from spreading?
Yeah.
Or is it to prevent a house from being burned? How do those things work? Because I think you've also alluded to the fact that people are going to need to install these mitigation. They're going to need to perform these, and they're going to need to get financing to do them. So sort of understanding what they'll do and what they mean, I think, is important.
So I think there are two levels of this. The utilities need mitigation. So we have a massive utility. These are huge service areas of hundreds of thousands of square miles, and they haven't maintained the grid. It's like running a train company where you don't maintain your track. And so both Paradise and the Sonoma fire, which was 2017, what broke are these huge pylons with 10,000 megawatts of power. The wires broke off the power line, off the pylon. They fell into the grass and they set a fire. And those are grass fires. These fires usually start in grass and shrubland, and then fire moves along the ground and then burns the homes. But the risks are twofold. It's embers. Embers are carried high into the atmosphere and then they come raining down. So if you don't have either a roof that's made out of clay, so tile roofs, or a roof that is truly fireproof, just that mass of embers raining down will make all the houses catch on fire. That's what we need to stop. And then it's radiant temperature. So houses heat up inside because if they don't have double pane glass, it's the fire actually is from the inside. It gets so hot, you open the door and these things just explode. And so those need to be curtailed by having double pane glass, which reflects the heat out. But if you have a pylon with, a huge wattage of electricity fall in the grass, and there's a wind, these are very wind related, all of these, no amount of mitigation is going to help. It may just burn off the roof rather than burning everything, but it's not going to help.
So one aspect of climate that we haven't talked about is sea level rise. And I think that's what a lot of people think about first when they think about climate changing. This is probably something in terms of the floods in Europe. Are the floods in Europe is that all really just about more intense storms, or is it about sort of changes in the ocean? What's going on with that? I know Bart has a physics background as well, so I'm probably asking him questions that were related to his PhD.
Yeah, well, it's both. Sea level rise is indeed a topic to be aware of. You saw, it was actually not shown on the map earlier, but so in the, let's say, the coastal regions, reinforcements, it's also about mitigating, taking the actions to mitigate and to build the higher dikes and so on. So it's very much on the attention. It is, however, a low probability risk. Yeah? So from a banking perspective, if you put the equations in the probability,
unconditionally zero.
It is very low, of course. So in that sense, the other type of floods, so the typical heavy rainstorm or the river floods, it's actually, if you look at it in recent years, it's mostly these heavy rainstorms that are, especially in very urbanized regions, and that are now becoming more and more pronounced. Because of higher temperature, you have, let's say, more intense rainstorms, and on the concrete, the water cannot disperse. While for river floods, again, there you can really mitigate. You can again build dikes and try to steer the water, make sure that the locks do not prevent the flow of the water and these things. So in that sense, there is for each of the three categories, there are, let's say, different actions.
Okay, well, this the conference is also about policy. So I kind of want to wrap up a little bit by allowing each of you to become a policy maker and just kind of list some of the things that you believe would have the biggest positive impact in the areas that you have studied. What policies would you like to see implemented, whether it's in California, whether it's in Florida, Europe, whatever? What would you do to address some of these issues most directly? We can start.
Okay.
Well, I think it's so, first of all, we need to provide regulators with the tools to help them with some of these decisions. And I think the modeling area are things that centers like this really can help with. They may not be super predisposed to listening to you right at this moment, but I think it is part of our mission. And that's why I'm going back to California tonight, because I do think it's really an important part of what we do. I think one thing we haven't talked about as much is many impacted communities for these kinds of risks are in no position to fund them at all. And so thinking more seriously about how we're going to provide, because at least wildfire risk is an externality risk, so if people are not enabled to help solve these problems, everyone's at risk. That we need better tools to help peripheral communities. We have tribes in California that are especially vulnerable. Just looking across the counties in California, the documents they prepare for disaster, whether it be flood or wildfire or any other kind of risk, are hopelessly differentiated by the economics of that county. So the rich counties have really good plans and the poor counties have no plans. And there's no way to harmonize that management. And then I do think there's some need for harmonization across the U.S. for some of these risks. And I think hydrological risks are one of them. Certainly wildfire risk in the West are a huge problem right now. It's not just California. And we need some, I don't know where it would be. I think some of our agencies are not set up well to deal with it. So I've been working with the Department of Energy. They've only just awakened to climate risk as part of their remit. They're kind of open to it, but it depends on the next administration, what will happen. But I do think that some of our agencies need to be expanded in terms of their horizons to see this as a national problem, not just letting each state deal with it or each locality deal with it, because people aren't prepared to do it at that level.
Yeah, I think I would say the property insurance markets in the U.S. Has extremely high levels of distortions that we saw, be it coming from rate regulation, be it coming from mortgage markets. And I think what the regulators are trying to do is solve this really difficult problem of trying to keep insurance affordable and available. But in sort of doing that, by having these regulations in place to keep prices low, or by basically allowing low-quality insurance companies to operate, just because we want to have some semblance of an insurance contract available to households, we are sort of leading prices and breaking, essentially making all of the price signals break down in a big way. And that actually has an effect back on affordability and availability, because insurance companies in California are not want to operate. And so what you were trying to solve to begin with by keeping prices affordable, you're sort of missing on that objective. And so it's not an easy task, of course. It's a really difficult problem with these risks growing, but I think the starting point is to sort of do away with a lot of these distortions. So in the case of Florida, one thing that you could do is simply raise, for example, the rating requirement from Demotech, but of course that would lead to, instead of a bunching at A, you would sort of start seeing a bunching at A double prime or whatever. And so you probably at the end of the day want to incorporate these risks in the G fees, and G fees could start giving the price signals to people. So for example, if I observe that my mortgage rate is so much higher if I obtain insurance from a Magnolia A-rated Demotech company versus a State Farm, I'm much more likely to then actually shop around and obtain good insurance rather than completely being fooled by the ratings of these companies, which is what is happening, because the ratings are not providing the signals of risk to people, and all of these companies look like they're all A-rated, but actually they're not not good. And I want to also say that the other thing that I would really urge policymakers and regulators to do is to solve the data problem in the insurance industry. I cannot begin to describe how poor are the data. and how difficult it is to really do any sort of research in this area compared to mortgage markets, where we have data available at the loan level. Here we struggle. So I showed you a lot of this stuff on Florida. The reason we are looking at Florida is because actually that's the only state where you have county level insurance underwriting data available. Like, it is not possible for us to sort of expand this across the US, the kind of analysis that we're doing across the US. And very hard to go anything below the zip code level. And so insurance companies are really reluctant to share these data, where they're selling, what they're charging, where they're canceling policies. And so I think that would obviously be the starting point for us to first start diagnosing the problems as to why they're exiting and so on. And then design the policies that will solve these issues.
I will actually repeat what Nancy was saying, also from my perspective. The academic or the scientific community, I think there is indeed a lot of work there still to be done. You are describing a very accurate or acute problem today, which has a certain trend, but actually also making progress in let's say, the expectation and forward-looking nature of things. This is very important to have a good grasp. And also linked to that, and that's perhaps looking into our own, let's say, the skills of the employees in the financial industry then. It's very difficult. Typical employee in a bank is not trained to let's say, have very good notion of terminology and things that come with all these environmental risks. They are typical economists, microeconomists, and other financial products engineers and these things. These are new risks, and so also there is training on staff or training at universities of these new risks can be advantageous. And the last thing that I already mentioned it, when it comes to politics and let's say the impact of politics on policy, constant policy is rather than a volatile. Yeah.
Okay. One more question?
Okay. So we're back here at 3:50 for our panel on retired finance, but let's give our panelists a hand. Thanks very much.